On February 23rd, Target's stock price was sitting at $189 per share. Just a little over a week later, Target announced their earnings, which shot their stock price up to $224 per share. Target recently reported that their earnings per share was $3.19, which beat analysts' expectations of $2.86 per share. Their revenue came in slightly below expectations, but their net income still rose by 12%, due to better margins on their products. The strong earnings report was great news for investors, but it wasn't until I took a deeper dive into Target that I realized that they have the potential to be one of the best dividend stocks over the next 10 years. In order to uncover the true intrinsic value of Target stock, we're going to jump into my stock valuation spreadsheet in Google Sheets. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. Okay, so we are currently looking at my stock valuation spreadsheet in Google Sheets. And on the spreadsheet, you can see we have 4 different valuation models. We have Graham's valuation, we have a discounted cash flow analysis, a multiples valuation, and a dividend discount model. And all 4 of these valuations are going to roll into my output tab, which will help me calculate the intrinsic value. So let's go ahead and start with what I think is one of the most effective ways to value a stock, and that is the discounted cash flow analysis. And in order to perform a discounted cash flow analysis, we need to project a growth rate for the future free cash flows of this company. And in order to do this, you can see I looked up the historical free cash flows for Target and found that they had an average growth rate of 31%. Now, 31% is an extremely high growth rate, and that is phenomenal for Target, but that's likely not sustainable when you look at industry standards. So I do expect Target to have really strong free cash flow growth. I'm projecting that to grow at a rate at about 11% over the next few years. So you can see I applied this 11% growth rate all the way out to 2030, and then I used it to calculate the terminal value. So after I did that, I then had all the future free cash flows calculated. I then took the present value of these future free cash flows, which you can see I did right here. I then took the sum of these future free cash flows, I added all of Target's cash and cash equivalents, and then subtracted their total debt. After doing this, it allowed me to calculate the equity value of Target. Once you have the equity value of Target, I then divided by their shares outstanding, and you can see this helped me find their intrinsic value based off their discounted cash flow analysis of $395.33. So let's go ahead and jump over to Graham's valuation now. And here on Graham's valuation, we're going to go ahead and come over here and use the formula that is commonly used today. And you can see the formula posted here. So essentially, in order to calculate what a stock is worth using Graham's valuation, the first thing we need is the earnings per share. So you can see we have that listed for Target right here. We're then going to take the price to earnings of a company with no growth and multiply that by the growth rate projection for the company, which is currently about 12. After that, we are going to multiply it by the average yield of AAA corporate bonds, which is about 4.4. And then we then divide it by the current yield of AAA corporate bonds, which at the time of this video is 3.3. When we plug all these numbers into Graham's valuation formula, you can see that we get an intrinsic value of $357 per share. So let's go ahead and jump over to our multiples valuation model. And essentially, the multiples valuation technique is a technique that utilizes different financial metrics from comparable companies to value the target company. So essentially, we're going to take companies that are similar to Target, and we're going to use them to help value Target stocks. Let's take companies like Walmart. We'll take companies like Home Depot. We can look at Kroger, and let's go ahead and look at Best Buy as well. And you can see with my spreadsheet, this data is going to automatically fill in. And so essentially, we're going to use this price to earnings multiple to value Target. So what it's doing is it's taking the stock price and dividing it by the earnings per share, which gives us our price to earnings multiple. I then take the average price to earnings multiple of these companies, which you can see is about $26. I then take this number and multiply it by Target's earnings per share. And this helps me find a multiples valuation for Target of $371 per share. So let's go ahead and jump over to our dividend discount model. And essentially, the idea behind the dividend discount model is we can value a stock based on how much that company pays out in dividends and what their dividend growth rate is. So you can see I just plugged in their quarterly dividend payouts over the past few years, which then helped me calculate the yearly dividends. And I use this to find the growth rate of their dividend payouts. The average growth rate of their dividend payouts over the past few years was a staggering 10.43%. That is an absolutely insane dividend growth rate, but much of that is due to a huge spike they had about a year ago, which was a 32% increase in the amount they paid out in dividends. That is a massive amount. So that's not likely a sustainable growth rate at 32%. So that's playing a big role in this 10%, but I do think that this company will continue to grow their dividends at a pretty aggressive rate, so I'm projecting a growth rate of about 8%. I then applied discount rate of 9.5%, which helped me find a valuation using the dividend discount model of $259 per share. So let's go ahead and jump over into our output tab. And here on our output tab, we can see what we found for each of these valuation models. Graham's valuation at 357, multiples valuation at 371, discounted cash flow at 395, and a dividend discount model at 259. And when we average all of these together, you can see that Target has an intrinsic value of $345 per share, which is a large increase from its current price of $224 per share. Now, I am a value dividend investor, and I think it's extremely important to always apply a margin of safety when making investments, as this is going to help reduce a lot of risk. So let's go ahead and I'm going to apply about a 25% margin of safety in this scenario. You can see based off of this, our acceptable buy price for this company is $259 per share. So our spreadsheet is telling us that this is a stock that we should be buying. Now, I am a huge believer that calculating the intrinsic value of a stock is one of the best ways to make great investment decisions, but it's also important to remember that at times it can take a while for a stock to reflect its true intrinsic value due to a multitude of reasons. But if you always seek to buy a stock based off of its intrinsic value while applying a margin of safety, you can be pretty confident that your investments will perform pretty well in the long term. So from a purely intrinsic value standpoint, I think Target stock could have a lot of potential, but from a dividend growth perspective, I think it has even more appeal and more potential. There's typically three different things that I want to look at when assessing a dividend growth stock. And if we jump over to our dividend discount model, the first thing I want to look at is the dividend growth rate, which we can see the average growth rate has been about 10.43% over the past few years. It might not be quite that high in the next few years, but I expect it to be at least around 8%, which is a really, really great dividend growth rate. But anytime you have a high dividend growth rate, you want to make sure it's sustainable. So let's go ahead and look at Target's payout ratio and what their free cash flow growth rate is. So let's look at their discounted cash flow analysis. And when we look at their discounted cash flow analysis, we can see their free cash flows right here. So like we discussed earlier, their average growth rate was nearly 31%. So to me, this makes me feel like their dividend growth rate is very safe and their dividend is very safe. But just to be sure, it's always great to look at the payout ratio as well. So I'm currently looking at finviz.com, and when I scroll down, we can see their payout ratio is listed right here, and it's 21.4%. That is a really low payout ratio, so that is phenomenal news for dividend growth investors. Let me know in the comments below what your thoughts on Target stock is. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching the video, and please don't forget to like and subscribe to the channel.